In the world of day trading, it's so easy to get overwhelmed by all the information out there. You will find tons of YouTubers charging hundreds of dollars for trading courses that basically has the exact same information that can be found for free if you know where to look. So my goal with this video is simple. I want to provide more value for free than what you find in a $300 course. This is the ultimate free day trading course for beginners. So the first stock I ever bought is a Swedish stock called Starbreeze, and I bought it right around here, or maybe here. The point is, I bought it pretty much at the top. However, I do not regret it at all, because that bad trade was the seed for one of my two biggest passions I have today, which is trading. The other passion of mine will be clear very soon. But my first trade was the beginning of a very long journey trying to really understand trading and markets. We talk about, reading about everything from the techniques of the founder of the Japanese candlestick chart, which by the way, 300 years later is still the chart type day traders use today. We talk about reading about, financial math, reading about price action and market structure, trading psychology, macro, investing, and this bad boy, which is, the classic by Adam Smith. This is the only book of all of these books I actually haven't finished.
Some of you are so weak.
But yeah, I hope you get the point. I have spent hundreds of hours reading about day trading and at least as much time in front of the charts. But on my journey, I have learned some super important things and necessary things, but I have also read about counterproductive and bad information. But my goal with this video is basically to extract all the most important information in the book and the most important knowledge I have for beginners and make a video about it. So I think you guys might know where I'm getting at. This video is basically the video that I wish I had when I first started my day trading journey. And as I said in the beginning, one of my biggest passions is trading, but the other passion of mine is education. I can't really set the finger on what, but there's something about, teaching that just makes me happy. I think it's fun. It feels like fulfilling. I have an easy time, getting into like a flow state when I teach. And when you do something that can easily make you, get into a flow state, I think that you are meant to do that. And also getting feedback from you guys, like, this or this comment makes it all feel, of course, even more fulfilling. But yeah, guys, this will be a super long video, so definitely don't feel like you have to watch it in one go.
Is that a challenge?
A tip is to, bookmark the video or add the video to a watch later playlist, or just, save the link or whatever so you can come back. Also, guys, in this video, I will have video chapters so you can clearly see what the chapter is about. If you want to jump over a chapter, you can feel free to do that. However, I have built this course in a sort of step-by-step manner. So what you watch in a previous chapter will benefit you in the next chapter. So I highly recommend that you go through this video in like a straight line from chapter 1 all the way to the end. Also, guys, as I'm recording this intro, I have already spent, I don't know how many hours making this video. It's a really long project. So if you appreciate these kind of videos, longer courses for completely free here on YouTube, it helps out more than you think, guys, if you show that by dropping a like on the video. The YouTube algorithm really loves the likes, it likes the comments and all that stuff. So if you have any questions or just comments, that's also super helpful. But yeah, guys, I think we're ready to get this started. And I think the very first question we have to answer is, of course, what is day trading in the first place? So before we can really dive in and talk about how to make money trading, technical analysis, and all that fun stuff, we of course first need to understand what day trading is in the first place. Well, in simple terms, day trading is when you buy something and sell something within the same day. You can day trade stocks, cryptocurrencies, Forex, but you could also trade, you know, sports cards or, I don't know, dinosaur bones. It could be anything really. The main point here is that day trading is when we buy and sell within the same day. And here we can actually split up day trading in 3 different categories. First of all, we have traditional day trading. When we talk about traditional day trading, we are usually talking about buying something and holding on to it for maybe an hour, maybe a few hours, maybe like 30 minutes. And when you hear day trading, this is what most people talk about. But we also have something called scalping. And as you dive deeper into day trading, scalping is a word you will probably hear a lot. And when we're talking about scalping, we're talking about day trading, but much faster. So scalpers may buy and sell within, you know, just a few minutes or sometimes even a few seconds. So scalping is a very short form of day trading, and this is usually more advanced. So what we will focus on in this video is mostly traditional day trading, but what you learn in this video can also be applied to scalping, that is extremely short form trading. Then, last but not least, we have something called high frequency trading, or in short, HFT. So if you see HFT coming up, now you know what it means. It means high frequency trading. And what is high frequency trading? Well, that is basically scalping, but one step further. High frequency trading is much faster than scalping, and here we're talking about complex algorithms and automation that does all the trading. In high frequency trading, you can basically buy and sell something within, you know, a fraction of a second. So this is the very extreme part of day trading. So this video will mainly focus on traditional day trading. We will also touch upon scalping, but high frequency trading is pretty much outside the scope of this video. So now the goal of day trading is very simple. Let's say that this right here is a price chart. So we have the price right here, we have the time right here. Our goal is basically to buy low and sell high. So let's say that you bought one stock down here for $100 and you sold up here for $110, then you made $10. But if you bought 10 stocks instead, then you made $100 in that short trade. If you bought 100 stocks, then you made $1,000 in that short trade, and so on and so on.
Yeah, boy.
But one beautiful thing about day trading is that you can also make money when the price goes down. And this is something I will talk about later in this video in the chapter long position versus short position. So the very first thing we need to know as traders is that we need to know what we are looking at. Or in other words, we need to know how to read price. This chapter will start with the very basics, and we will talk about how to read candlesticks. Pretty much all traders today use something called a candlestick chart, and we will take a look at everything you need to know about that. But in my opinion, the real interesting things start to come when we dive deeper. As this chapter goes on, you will soon realize candlesticks tells us more than where the price is and where the price has been. They also give us hints of where the price will go next. And we will talk about all about that, but let's start with the very basics. So first of all, we have 2 different types of candles. We have a green candle and we also have a red candle. The green candle is called a bullish candle and the red candle is called a bearish candle. A green candle means that the price was going up during this time period, and a red candle means that the price was going down during the time period. And what do I mean by time period here? Well, each of these candles can represent different time periods, or what we call time frames. So each candle can represent, for example, 1 day, or they could represent, for example, 1 hour, or perhaps 5 minutes. This right here is what we call time frames. So for now, let's say that these candles represent 1 day. Traders usually use terms like I'm currently trading on the daily time frame. That means that every candlestick on the chart represents 1 day, and so on and so on. And every candlestick on the chart has 4 important points. First of all, we have the open. So this right here is the open. Then we have the close. Then we have what is called the high. And last but not least, we have the low. And let's for now focus on the green or the bullish candlestick. And the open is basically where the price starts. So if this right here is a daily candle, this means that the price is down here when the day starts. And the low point is the lowest point the price has been. So during the day, perhaps the price started to go down like this to the low. Then the price went all the way up here to the high point. The high is the highest point the price has been during that day, and then before the day closed, the price went down to the closing point. So we basically have the open, we have the low, we have the high, and we have the close. So this is how the price could have moved during that candle. And if you're talking about daily candles, this is how the price could have moved in that day. But now, and this is very important, the price could have actually moved in another fashion. For example, the price may have started down here, and during the start of the day, perhaps the price went up, then perhaps the price went down a bit like this, down to the low, right? And during the day, perhaps we had some moves like this, up to the high, and then down to the close. So as you guys can see, here we still have the open right here, we have the low down here, we have the high, and we have the close. So a candlestick can tell us where the open, high, low, and close is, but it can't really tell us exactly how the price moved within the candle. And by the way, if you come across these four letters, OHLC, this basically stands for open, high, low, close, and that can be, good to know. And now when we know how a green or a bullish candle works, now it will be easy to understand the red or the bearish candle. So during a red candle, remember, the price goes down during the time periods. Let's say that this right here is 1 day. The only difference here is that the red candle opens up here and closes down here. So it's the exact opposite of the green candle. Perhaps during this red candle, the price moved something like this. So now guys, we are ready to dive a little bit deeper here, and it will start to get more and more interesting. Now we're gonna talk a little bit about how a deeper understanding of candlesticks can actually give us hints about where the price is likely to go next. So let's start by taking a look at these two candles right here. The first thing I want to notice is that both of these candles opens at pretty much the same level. So we can just write an O here for open, and we can also see that the closing price for these candles was also pretty much at the same level, right? And also the highest point of these candles pretty much at the same level. However, if we look at this lower part of the candle, we can see that they look very different. By the way, the small lines we have above and below the candles is what we call wicks. So this right here is a wick, this right here is a wick. Another name for these lines are shadows. So that is sometimes used. So if you hear shadows, you know that they talk about the small lines. And I can also just mention that the sort of wide part of the candle, so for example this part right here, is often called either, the candlestick body, or some people will call it the real body. So we have wicks and bodies. But for now, I do want to focus on the low points of these two candles, because these two low points are at completely different levels, and this will really affect the story that this candlestick tells us about the price. So let's for example imagine the price of the candle to the right here. As we can see, the candle, remember, it opened all the way up here, but during the candle the price fell a lot. It fell all the way down here to a lowest point down here, but then during the candle the bulls regained control and managed to push the price all the way up here. So here we can see that we are talking about a strong reversal of the price. So this candlestick right here basically tells us that we are seeing a reversal of the price. But if we compare it with the candle to the left here, we can see that this candle opened here. During the candle, it went all the way down here, it went up here, and then it closed here. So this price right here is very different from this price. So even though these candles opened, they had the same high, they have the same close, they tell us very different stories and give us different hints of what the price might do next. So now the specific candle I just recently talked about that looks like this actually has a name. This right here is what we call a hammer. And as you can see, this candle pretty much looks like a hammer, right? And the reason this candlestick has a name is because this candle actually has some predictive power and it can give hints about the future. But in order for this candle to have some predictive power, it needs to appear at a certain point in the market. So a hammer pattern is actually significant if before the hammer appears, we need to see a trend towards the downside. So imagine that these candles right here are red or bearish candlestick patterns. So these candles basically mean that before the hammer appears, we have a downtrend. But then suddenly we see this green candle formation. And I want you all to imagine how this price looks like. First, we have a downtrend with all of these red candles, but then this hammer appears. And remember, the hammer is a strong move towards the downside, but then quickly the price reverses to the upside. So as you can see, if we draw this out as a line chart, you can see that it looks like the price is reversing to the upside. And this is exactly what a hammer tells us about the price. This right here is what we call a candlestick pattern. And to be specific, it's a hammer candlestick pattern. And if this pattern appears after a downtrend, it indicates a reversal to the upside. Candlestick patterns are different formations and combinations of candlesticks that tells us something about the price. A candlestick pattern can consist of just one candle, like for example right here, but they can also contain multiple candles. And for all candlestick patterns, the context is very important. So where on the chart the pattern appears matters a lot. So now I want you guys to imagine, let's say that the price went, sideways, up and down, and then this pattern appeared right here. What does the pattern tell us about the price now? So before the hammer appeared, the price went something like this. Then the hammer appeared, so the price went all the way down here to a lowest point. It went all the way up, and before the close, it went down something like this. And as you can see, because we had a price that looks something like this before the hammer appears, this will not longer be a clear sign of a reversal. So where the candlestick appears on the chart is super important. Now guys, we're ready to take a look at another candlestick pattern consisting of two candlesticks. But before we do this, if you guys are getting some kind of value from this video so far, I would so appreciate it if you can show that by dropping a like on the video. That would definitely mean a lot to me. But now I want to show you guys a specific pattern called the bearish engulfing pattern. The first candlestick of this pattern is a green one. And the important part about this green candle is that it needs to appear after an uptrend. So before this pattern appears, we want to see an uptrend. You can see we have many green candles here. The green candle itself should close pretty near its high. So it should close near this point right here. And preferably we want to see a relatively large body. So we want this part to be, pretty large here. And the second candle is a red one. And the important part here is that the red candle should open above the close of the previous green candle. So it should open up here or even higher. But then during this candle, the price should go down so low that it closes. The close of the red candle should be below the open of the green candle. So the body of the red candle should completely engulf the green one. At least it should engulf this part. You can see the body of the green one. The red body should be larger and engulf the previous green candle. If you see this pattern coming after an uptrend, then this is a bearish reversal pattern, indicating a reversal to the downside. Alright, so now when you have a slight understanding of how day trading works, and you also know how to read price, now you guys are ready to learn about the only platform you need to get started with day trading, TradingView. TradingView is where you will find all your stock, crypto, and Forex charts. And it is in TradingView we will do all our analysis to understand when to buy and sell. And just a quick heads up before we dive in the next clip I will have a beard and might look, you know, a few years, perhaps a decade older. And that is because the next clip was recorded like 1-2 weeks ago. So to get started with TradingView, you want to first head over to TradingView.com. When you first open up TradingView, it should look something like this. And the very first thing we need to do here is that we need to sign up. Because if you don't sign up, you will get this pop-up window, and when this window appears, all your analysis will be deleted. The good news is that signing up for TradingView is free and very simple. And for the sign up process, I have actually managed to get a special link from TradingView that will be both in the top comment as well as in the top of the description. You can use this link to sign up to TradingView for free. But then if you later on decide that you want to upgrade your plan to a pro or premium version, you will get a $15 bonus towards your plan, and at the same time I will get a small commission.
Yeah, boy.
So that is a great way to get benefits and help out the channel at the same time. So the best way to sign up is to use the link, but if you for some reason don't want to, you can simply go to TradingView.com and press on get started right here. So after clicking on the link, you should get a window that says you were invited to TradingView. Then you want to click on join now for free. And here you can go through a simple sign up process using Google, Facebook, email, and so on. So now I have signed up and I'm logged in to a free TradingView account. And let's start here by taking a look at the different TradingView plans. So I want to go up here to the upper right corner and press on upgrade right here. And we basically have 4 different options. We first of all have the free option, and this is what I recommend all beginners to start with. You can start off with the free option.
It's free! I saw that.
Then if we scroll down a bit here, you can see that we have 3 different paid plans. We have the essential plan, we have the plus plan, and we have the premium plan. And if you guys want to, you can also see that you can actually try out all of these plans for 30 days for free. So if you are a complete beginner, I either recommend that you go for the free version or that you go for one of these 30-day trials. Right, okay, so now I have logged in to a free TradingView account. And this right here is the starting screen for TradingView. As you guys can see here on the starting screen, we have a few popular markets such as Bitcoin, Tesla, and Apple. You can get a sort of little overview of what's going on. We also have a few tabs here: products, community, markets, news, and so on. You get a nice little overview here. But I think that the very first thing and the very first step we need to understand is how do we open up a chart. So to open up a chart, you want to go here to the products tab and you want to press on the super charts button. And now, as you can see, we have opened up our first chart. The standard chart that tends to open is Apple. Right now we're looking at an Apple chart, which you can see in the upper left corner. You can see it says Apple Inc. right there. And if you want to change the market, so you want to look at another market, what you simply do is that you go up here to the upper left corner, you press where it says AAPL right here, and here a window pops up and you can search for any stock, cryptocurrency, or whatever you want to trade. And here, when you want to search for something, let's for example say that you want to open up a Bitcoin chart, what you can do and what many people will do is that they want to search for Bitcoin. But if you want to find markets more effectively, what you preferably want to search for is actually something called a ticker symbol. So for example, the ticker symbol for Bitcoin is BTC. The ticker symbol is basically a few letters that are assigned to a specific market, and this will make TradingView understand better what you're actually searching for. To find the ticker symbol for a market, you can Google it. So you can, for example, Google Bitcoin ticker symbol or Google Apple ticker symbol. For example, for Apple, the ticker symbol is AAPL. So you can see if we search for AAPL, we will find Apple right away. If we want to find the Tesla, I think it's at TSLA. So you can see if we search for TSLA, we will find Tesla. But now let's open up a Bitcoin chart. So what we do is that we search for the ticker symbol. So we search for BTC. And here this can look a bit confusing because as you can see, we have many different Bitcoin markets here. And you may of course wonder, you know, what is the difference between these charts? Well, as you can see on the right here, you can see that we have different sort of exchanges for Bitcoin. And this is simply because Bitcoin is traded on different crypto exchanges. So for example, you can see that the top here is Bitstamp. You can see that the second one here is Coinbase. Coinbase is the largest crypto exchange in the world, if I'm not wrong.
What? Bro, what are you talking about, man?
So let's open up a Bitcoin chart here, or to be more precise, let's open up Bitcoin on Coinbase. So now as you can see, we have opened up the Bitcoin chart. So now I'm going to talk about something very important and something that will make your TradingView experience much more pleasant. And that is basically how do we move around the chart? How do we, you know, zoom in and zoom out and sort of navigate the chart in an effective manner. This is very important, and this is something that I remember was pretty confusing when I got started. So first of all, the very first thing you want to do is that you want to go down here to the bottom right corner, and you can see that we have a button here which says A. You want to make sure that this button is unchecked, because if we have this one checked, let me check this one, as you can see now when we navigate the chart, it will automatically zoom in and zoom out. So if you have this button checked, you are not really free to move around the chart as you want. Some traders uses this, but most traders don't use the auto zoom button, and I recommend that you know, at least in the beginning, don't use this one. It's much more effective in my opinion to be able to zoom in and out freely. So what I'm gonna do here is that I'm gonna make sure that we have the auto button unchecked here so that we can move around freely. So now then, how do we zoom in and zoom out? Well, the most basic way is, first of all, if you want to zoom in and out, you can hold on to the right side where you can see all the prices. So you hold your left click button and you can drag, you know, down and up here to zoom in and zoom out on the vertical axis. And you can also hold your left click button on the sort of lower part where you see all the dates and such. And then you can basically zoom in and zoom out on the horizontal axis. However, in my opinion, this is not the most effective way to move around. The most effective way to move around in TradingView, in my opinion, some traders differ a bit how they do this, but this is how I do. First of all, what you can do is that if you hold your left click on your chart, you can see that you can move around the chart by just holding on to your left click. And this is how I move around. But what I also do is that I move around like this, and then I use my mouse scroll button to zoom in and out here on the horizontal axis at the same time. So this is basically how I move around the chart in a quick manner. And I also use the sort of sidebar here to zoom in and out. So this is basically how I move around you know, quickly in TradingView. Another sort of tip or trick for you guys is, you know, if you want to zoom in on a specific point here on the chart, let's say that I want to zoom in. Let's say that I want to zoom in right here. What you then can do is that you can hold your control button and you want to make sure that you hover your mouse over the point where you want to zoom in. So you hold control, you hover your mouse, and then you use the scroll wheel button. And as you can see, then you will zoom in to that exact point. Let's say we want to zoom in at this exact point right here. Then we hover the mouse above, we hold control, and then we basically use our mouse scroll wheel to zoom in to that specific point. So that is a quick tip that you can use, you know, to navigate the chart a bit more easy. Now guys, let's take a look at, you know, what about if you want to look at a chart, let's say that you want to look at a chart on a sort of very long time perspective, like for example right here. As you can see, in this case, you can see that the recent price movements take up a very large portion of the chart, while the sort of price movement from, you know, long time ago, you can't barely see it on the chart as of right now. The solution to this is to use a logarithmic scale. So what you want to do here is that you go down once again to the bottom right corner, and now you actually want to use the auto zoom, but you also want to click on this L button right here, which says logarithmic. So let's press on that one. And now, as you can see, the chart looks completely different, and that is because now the movements we couldn't even see before, now these movements are clearly visible on the chart. And what the logarithmic mode basically do is that the price movements from a long time ago will take up about as much as the recent price movements. I will not go into detail, the math behind the logarithm scale, but what it's meant to do is basically so that, small movements from long time ago, you can see them much more clearly. But since most traders are focusing on the recent price, it's pretty uncommon to use the logarithm mode. So now I'm gonna uncheck the logarithm mode and I'm gonna uncheck the autofill. So let's go back here to the recent price right here. So now I'm gonna take a look at something that I get asked a lot regarding TradingView, and that is, how do I change the appearance of the chart? Many traders prefer to not use a white chart. It's very bright for the eyes. So now the first thing I want to show you guys is how do we change TradingView to a dark mode. The most simple way to do this is that you simply right click on the chart, you go down here to where it says color theme, and you press on dark. And now, as you can see, the background of the chart is dark, and you can also see that the sides are dark. Everything is much darker and more pleasant in my opinion. However, some users of course prefer white background. It's a purely personal preference. But also guys, many people of course want to customize their chart even further. For example, make it darker, make it brighter, or even change the colors of the actual candlesticks. And to do that, you want to make sure that you right click on the chart and you want to go here to the settings tab. Now you can see a chart settings button appear here. And if you want to change how the candlesticks look like, you go up here to the symbol tab right here. And here you can see that we have many customizable things. The first one is, the candlestick body. And as you can see, if we, for example, uncheck this one, so this is how it looks like checked. But if we uncheck this one, you can see that the candles will be sort of hollow. The middle part of the candles will disappear. Some traders actually use this kind of chart. I think it looks pretty cool. Actually very cool in my opinion. So you can do that if you want to. But what you also of course can do is that you can change the color of the chart. So the bullish candles the standard is green here, but you can change them to, for example, white if you want to. Some traders use white for the bullish candles and black for the bearish candles. Then you can change the border to black and white as well, and you can change for example, the wick to black and white. And if we press OK now, you can see that we have a pretty cool chart that looks something like this. You can basically, if we go back here to the settings tab, you can customize your own candles however you like. There are many different options here. So if I were you, I would take some time and make a chart that really looks nice to you. Then we have a few other settings here. These ones, the status lines are, in my opinion, the standard settings are good. The standard scale settings are good. Here on the canvas button, here you can change the sort of background of the chart. So this is very important. For example, right now you can see that we have a background with a gradient. But let's say that we want, a completely, for example, black background. Then we can click on solid right here and change the background to black. Now, because we have black candles, you won't be able to see the candles. Let's, for example, change to gray right here or something like that. Basically, feel free to mess around with this however you like. You can choose to, disable the sort of lines we have on the chart, right? So you can, for example, press none right here and the lines on the chart will disappear. But I will not go into too detail about the settings. I think they are pretty straightforward. But as I said before, make sure to take some time to customize your chart to exactly how you want. I can just mention, now we have messed around a lot with the chart here. So if you want to go back to the basic settings, you simply go down to this button right here and you click apply defaults. Now the chart will go back here to the basic settings, but we are on the dark mode. And if you want to change back to the light mode, you do exactly as I showed you guys before, but you press on light. Alright guys, so congratulations. If you have made it this far, you have now completed the most basic part of the course. From this point and going forward, the course will only get more and more interesting. But this point is also where you guys need to pay more and more attention. So if you guys need a well-deserved break, I think that now is a good point. Do your stretches, refill your coffee mug, and perhaps grab a notebook. Because now we're gonna talk about two concepts that every successful trader understands intuitively. I'm talking about market structure and price action. And these are two concepts that needs to work tightly together in order to be profitable. Think about it like this. A football player that has great dribbling skills but can't shoot or pass will be a decent player at best. But if you have a football player that can shoot and pass but has very bad control and dribbling, that player can also be decent at best. But if you have a player that can combine these skills together, he will not only be twice as good, but he can be 10 times or 100 times as good as the other players. So make sure that you really pay attention to both of these concepts and how market structure and price action works together. Let's start here by learning about market structure. Market structure is about understanding the market on a macro level. And you may wonder, what is macro? Well, macro basically means large. So market structure is about understanding the big picture of the market. A market can be in 4 different states. First of all, the market can be in an uptrend. And I think that most of you guys can clearly see that, you know, this market right here is in an uptrend. But when you look at real markets, it can often be so much harder to tell whether we are in an uptrend or not. So in order to determine if we are in an uptrend, we need to have rules. We need to know exactly what to look out for to determine if we are in an uptrend or not. Now let's quickly talk about some important terminology we need to understand these rules. First of all, the moves that goes in the same direction as the trend is what we call swings, and the moves that goes in the opposite direction of the market is what we call pullbacks. The top of the swings is what we call highs, and the bottom of the swings is what we call lows. And in order to have a real uptrend, we need to see both consecutive higher lows, and we also need to see consecutive higher highs. If we have higher highs and higher lows, then we are in an uptrend. A downtrend is the same thing but the opposite. In order to have a downtrend, we need to have both consecutive lower highs, and we also need to have consecutive lower lows. Another word for an uptrend is to call it a bullish trend. And another word for a downtrend is a bearish trend. The next state the market can be in is a trading range. And in a good trading range, we want the highs here to be at, you know, around the same level, and we also want the lows to be around the same level. And we want to see at least 2 highs and 2 lows. The last market state I want to talk about is a choppy market. And this is when the price moves so randomly that we can't really determine any market state at all. And a very important thing about choppy markets is that these are markets we pretty much always want to avoid completely. We have good trading strategies in bullish markets, in bearish markets, and in trading ranges. But when we have a choppy market, this basically means that the price in this kind of market is highly random. And when the market is too random, it will be extremely hard to make money. When we study trends and market states, it's of course very important to be able to notice what state we are in right now, but it is at least as important to study how trends end. So remember the definition of an uptrend. In order to have an uptrend, we need to have consecutive higher highs and higher lows. So what would happen if the price breaks below this point right here? So from this point, let's say we see a strong move to the downside and the price falls below that point. My question to you is now, what market state is this market in right now? If you want to, pause the video and drop a comment down below. Well, first of all, since the price broke this point right here, we know that we are no longer in an uptrend, because in order to have an uptrend, we need to print higher lows, right? But as we can see, now we have one low and then a lower low. So now you might think, this is easy. We are in a downtrend, right? Well, we actually don't know that yet, because let's say that the price moves something like this after that point. Then you can see that yes, we have two lower lows, but at the same time we have one high and then a higher high. So here we can't identify a market state. However, if the price from this point moved something like this and then started to drop again, now we can see that we have one high and then a lower high. We have one low and then a lower low. So now we know that we are in a downtrend. Now let's talk about some important terminology that you will hear a lot in the trading community. First of all, when the price breaks to a higher high, or in a downtrend, a lower low, this right here is what we call a break of structure, or for short BOS. So if you ever see the letters BOS, now you know what that means. And if you see the price breaking below the most recent low, like we saw right here, this is what we call a change of character, or for short, CHOCH. And here I want to point out a common mistake that I see new traders make all the time. And that is that they think a change of character automatically means that the state of the trend is shifting. But you already know that a change of character doesn't necessarily mean that the trend will go, from an uptrend to a downtrend or downtrend to an uptrend. It simply means that the previous market state is over. So now let's talk about the market cycle and two concepts called accumulation and distribution. And this is basically a big framework developed by Charles Dow of how markets tends to move. The first phase of the cycle begins after a downtrend. This is a phase when prices have fallen to attractive prices, but the general public and small traders like me and you are often still bearish and skeptical. During this phase, smart money like big banks, hedge funds, and other financial institutions start to buy, or in other words, accumulate assets. So this right here is what we call the accumulation phase, is then followed by an uptrend, or in other words, a markup. This is when more and smaller traders tend to jump in. The public sentiment and the media is starting to shift to positive and bullish, and this drives the prices even higher. This goes on until the price starts to plateau. In this phase, the smart money that bought all the way down here starts to sell positions, but they don't want to sell their stuff too fast because they don't want to push the price down. They usually try to sell over a long period of time to not push down the price. This right here is the distribution phase. And because the price doesn't push higher, this will lead to media and the public starting to turn a bit. Small traders start to look for other opportunities, and so on and so on. And this will eventually lead to the markdown. And your ability as a day trader to really zoom out and look at the market from the big picture can really help you identify better trading opportunities. So let's say that we identify the exact same type of trade right here on the orange dot, and for example right here on this orange dot. Even though the micro might look the same, the macro tells us a very different story, and this can mean that this trading opportunity down here is much better. Alright, so now let's talk price action. Price action is one of the most important aspects of trading with technical analysis. And it's very unfortunate because I see people mix up price action and market structure all the time. I have even seen this happening, on the larger trading channels on YouTube. So we need to get this straight. Price action is micro and market structure is macro. Or in other words, market structure is when we zoom out and take a look at the big picture. Price action is when we really zoom in and take a look at how is the price behaving right now. And to get the most out of this chapter, I highly recommend that you have watched the previous chapter on market structure, because in order for price action to work, we need to also understand market structure, and the same goes in both ways. And let's actually begin this chapter on price action by taking a look at a trading range. And remember from the previous chapter that a trading range is when we have, the prices going sideways and printing highs at the around same level, and also printing lows at the around same level. So when we're looking at the price from this perspective, we're looking at it from a macro perspective. But price action is all about the micro. It is about what the price is doing right now. So now let's say that we zoom in to this point and take a look at what the price is doing. So imagine that this blue line right here is the top of the trading range. And the price is going up right here towards the top. We have some green candles like this. And I actually want to take a look at two scenarios. So let's split this one in two parts. So we basically have two different worlds. This is world 1 and this is world 2. And in the first example, we see the next candle looking something like this. It is a very strong bullish candle, closing far above the top of the range. But in the second world, we can see that the price actually pushed up to the exact same level. However, before the candle closed, we can see that the price closed far below the top of the range. So these two examples may look very similar on a macro perspective, but when we zoom in to the micro, we can see that the price action tells us a very different story about the price. To the left, we see a momentum candle, which is a candle with a much larger body than the previous candles. And when we see a momentum candle closing above a support or resistance, in this case, we're talking about a resistance. By the way, later on in this course, you will learn all about support and resistance. But for now, let's just note that when we see a momentum candle closing far above a resistance, this makes it likely that this is a breakout and that the price will continue going up. However, in example 2, we have a completely different story. This candlestick right here is what we call a bearish shooting star. And a bearish shooting star on its own is a bearish signal, and it indicates a potential reversal to the downside. But it's also very important where the shooting star appears, and that is when market structure comes into play. And remember that this right here is a zoomed in picture. So if we see a shooting star appearing at the top of a trading range, this makes it more likely that this is a valid shooting star and more likely that the price will reverse to the downside. So I hope that this little example helps to demonstrate, really the difference between price action and market structure. We're talking about zooming in and zooming out. By the way, guys, if you are getting any kind of value from this video so far, I always get so caught up in my teachings. So I forget to ask, but it's important for the algorithm and all that stuff. If you get some value, I would so appreciate it if you show that by dropping a like on the video. So let's just talk a little bit more about momentum candles, because many times your ability to understand momentum and momentum candles can, make or break a trade. So what do we really mean when we're talking about momentum candles? To make it simple, I usually define momentum candles as a candlestick that has a body that is at least 2 times larger than the average of the candles preceding the momentum candle. And preferably, I want it to be more than 2x. Preferably, we want to see, a real body that is 3 times taller or even more. And the reason why these candles are so important is because they clearly tell us that something about this recent candle is very different compared to the previous candles. So let's once again imagine that we have an uptrend right here. And remember from the market structure chapter that if the price can push above this point right here, then we have a BOS, or in other words, a break of structure. And if we see a strong momentum candle coming in at the break of structure point, so let's say that we see a strong candle right here, this increases the likelihood that we are actually seeing a real break of structure. But let's say that we instead have a candle that maybe looks something like this. It has a green body, it closes slightly above the break of structure level, but maybe the candle looks something like this instead. This candle will make it less likely that we're actually seeing a break of structure, because if we imagine the price inside this candle, you can see that the price action inside this candle looks something like this. And this right here is not an indication of a clear breakout, a clear break of structure. It's more an indication of uncertainty. And when we see uncertainty coming in at important market structure levels, This is usually a sign of caution. And these type of candles actually have a name, and they are super common and they are important to understand. So I think this is a good segue to talking about doji candles. So now I want to talk about a special sort of candlestick family, and that is doji candles and spinning top candles. And these are all candles that represent uncertainty. And let's start by taking a look at spinning tops. Spinning tops are candles with large wicks and small real bodies. And they can be either, you know, green or red. For spinning tops, the color of the candle is not very important because spinning tops always tells us pretty much the same story. Because let's imagine the sort of price movement within, you know, any of these two candles. You know, it starts around here, and during the candle it goes down, it goes up, and it goes down again. And since the body of the candle is so small, this will be true for both these types of candles. So what spinning tops basically represent is that they represent that the market is uncertain. And where the spinning tops appear is super important. So are the spinning tops appearing at a resistance level? Are they appearing in an uptrend, downtrend, and so on and so on? You always want to use market structure and price action together. As for doji candles, it's super similar to spinning tops. But in this case, the bodies of the candle, so this part right here, have shrunken down so much that the body has completely disappeared. So doji candles look something like this. The body doesn't have to be in the middle. A doji candle could also look, you know, maybe like this, or some candles look something like this. But what's common here is that spinning tops and dojis all signals uncertainty. So let's imagine that we have a market that looks like this. Would you trade or would you avoid this market? Well, because we have so many spinning tops and so many doji candles, this signals that the market right now is very random. Or in other words, we're talking about a shopping market. And in, you know, pretty much all cases, this is a market we as traders want to avoid. So now you know a little bit about market structure, you know a little bit about price action, and hopefully you're starting to see how price action and market structure works together. Something I have mentioned here and there are support and resistance. So now let's dive deeper into one of the most common, but at the same time, in many ways, one of the most misunderstood concepts in trading: support and resistance. So when it comes to support and resistance, you may have heard many different explanations. A common one is that a support level is an area on the chart where the price sees multiple reactions to the upside. And a resistance level is an area on the chart where the price sees multiple reactions to the downside. And this definition is not entirely bad or wrong. However, it can be improved. Because later on in this video, you will, for example, learn that we don't need multiple reactions in order to find strong support or resistance. And you will also learn that sometimes multiple reactions from support or resistance can actually be a very bad thing. So a better definition, in my opinion, is that support and resistance is an area on the chart where we see an imbalance between supply and demand. If we have more demand than supply, the price will be pushed up. And if we have more supply than demand, the price will conversely be pushed down. To understand one of the biggest mistakes when it comes to support and resistance, we need to think about what the purpose of support and resistance actually is. And that is simply to make the chart easier to analyze. And if you look at my chart right now, you can see that it's a clear and easy to understand chart. But what I often find is that beginner's charts often look something like this. If your chart looks like you are trying to solve quantum mechanics, you are definitely doing something wrong. You need to take a step back and think about the purpose of support and resistance. It's all about making the chart easier to read and easier to understand, not harder to read and understand. So now guys, we're getting to the real exciting part of the video. I will teach you guys some of the most important rules, and I do think and hope that many of these rules will be completely new for you guys and will be super helpful. So let's take a look at the first rule right here. Something you may have heard about support and resistance is that the more reactions we get on a support level, the stronger it becomes. And this is actually true in some situations. But what you need to understand is that depending on how the reactions look like, this can tell us a lot about the price. So for example, let's look at this Bitcoin chart right here. You can see that we have a very significant support level with multiple touches. If you take a look at this touch right here, you can see that we had a very strong reaction towards the upside. This is a good sign that we're talking about a strong support level. And as you can see, later on, the price came down to the support level and we once again saw a strong reaction. But what we already can notice here is that the reactions on the support level are getting weaker and weaker. If we look a bit more to the left here, we can see that we once again got a reaction, but this time it was even weaker. After this reaction, the price started to crawl near the support, and then we saw a massive spike down. So the first important rule here is that when we have lower highs, consecutive lower highs into support, this is actually a sign that the support is getting weaker. Let's use what we just recently learned and take a look at this chart right here. As you can see, we saw support coming in one time, the price went up, the price came down, and we saw support coming in once again. We can use this information to draw a valid support line on the chart. But more importantly, what you can see here is that the reactions are getting stronger and stronger. This is an indication that we're talking about a strong support and that the support is more likely to hold for yet another bounce. And as you guys can see, in this case, the price came down to the support once again and got another bounce. The next rule I want to talk about is critical to understand. And if you can master this rule, you can improve your trading by a lot. So I want you all to take a look at this chart right here. As you can see, on this point right here, the price got a strong reaction towards the upside. However, unfortunately for the bulls, the support level did not hold. But if you look a bit to the left here, you can see that the price eventually started to go up towards this previous support level once again. And you can see that this time we got a strong reaction as resistance. If we look even more to the left here, you can see that the price once again came up here to the resistance level at this point, and we got another reaction. Later on, after a small reaction right here, the bulls managed to push the price above the resistance. And the interesting thing is that if we look even more left here, you can see that this previous resistance flipped to become support, right? Looking even more to the left here, we can see that this exact level acted as support once again. So you probably get the point by now. Previous support can flip to become resistance. But in order to find the best levels, I want you to have the rules I talked about earlier in mind. And what you also can do is that you can use indicators to improve your support and resistance levels even further. So now guys, we are finally ready to take a look at some of the best indicators out there to improve your support and resistance levels. So let's just open up the first indicator right away. So what we want to do here is that we go up to the indicators tab in TradingView, and what we want to search for here is pivot points high low. And as you guys can see, we have tons of different TradingView indicators based on pivot points high and low. But in my opinion, one of the best and most straightforward pivot point indicator is the one here at the top that is simply called pivot points high low. So let's open this one up. Now we need to change a few settings. So we go up here to the settings tab for the indicator. The most important setting here is the length left/right. And you can see that we have the pivot high where it says 10 and we have the pivot low where it says 10. And by changing these settings, we can make the pivot points, which are significant points in the market, we can make them more or less significant. So if we increase this number, let's double all the numbers here to 20, you will see that we will get more significant pivot points in the market. So let's do that and press OK. And how can we use this indicator to find the most significant support and resistance levels? Well, if we zoom out a bit here, what you will realize is that many of the best support and resistance areas will contain many of these pivot points. So you can, for example, see that the support level we talked about earlier, which is this gray area right here, contains multiple pivot points. And remember what pivot points are. They are basically significant levels in the market. Let's also zoom in here a bit on this area. You can see that we have yet another key support that flipped to become resistance. And not surprisingly, this area contained multiple pivot points. You can see pivot point as support, pivot point as support. We broke support and we flipped the support to become resistance. If we zoom out a bit here and look back even more, we can actually see that this one was a key support all the way back here as well. Now let's open up our next indicator. So we go up here to the indicators tab in TradingView. And what we want to search for here is quant and then view, so quant view. And you can see that this creator have made so many indicators, so a big shout out to quant view. Thank you very much for your work. But the indicator we want to use here is, let me check here, it should be somewhere here. The indicator we want to use here is called trendline pivot. You can see that this indicator is one of his most popular ones, and that is for a good reason. Now it's important to change a few settings. So we go up here to the settings tab for the indicator, and we want to make sure to be on the inputs tab right here. And you can see that we have a few different settings. You can change the color of the indicator and so on and so on. And the first setting you want to look at is the max number of crossed lines. The standard number here is 4, but if you want more data, you can increase this one. However, what I recommend and what I usually do is that I keep this one as 4, because what we are interested in here is only the recent price action. For the source, you can keep this one at close, and you can keep the max line length here to 252. But as for the pivot length, remember that we changed the settings for our pivot point indicator to a period of 20. So what I'm gonna do here is that I'm gonna match the pivot point indicator with this indicator. So you do want to change the pivot length here to 20. Now we are ready to press OK here. And as you guys can see, what this indicator basically do is that it automatically draws sloping trend lines. And one very interesting thing is that you can see that the pivot points, so you can see we have one pivot point right here, and we have one pivot point right here. What this indicator does is that it draws the trend lines based on the pivot points. And another amazing thing you can see about this indicator is that when we break trend lines, you will get an automatic signal that we see a breakout. You can see this green cross right here means that we broke a significant level. Let's look a bit more to the left here. You can see that we have yet another trend line, for example, right here. Once again, you can see that it's based on the pivot points from the previous indicator, and you can also see here that we get the signal when it breaks out. So pretty much all technical analysis is built upon two things: analyzing the price, but also analyzing the volume. And so far in this course, we have pretty much only been talking about price. So now it's about damn time to take a look at volume analysis and how that can take your trading to the next level. So first of all, we have to answer the simple but very important question: what is volume? Well, volume is simply put the number of assets that changed hands in a specific time period. And to make this a bit more concrete, in the case of the stock market, it's the number of shares that changed hands in a specific time period. For example, if we're looking at a daily time frame, it's the number of shares that got traded during that day. If we're talking about cryptocurrency, it's the number of coins that changed hands in a specific time period. And if we're talking about Forex, it's the number of currency pairs that changed hands in a specific time period. Alright guys, so now let's take a look at how volume works. Well, first of all, to open up the volume indicator in TradingView, we go up here to the indicators tab and we simply search for volume. We have a few different volume indicators here, But in this video, we're gonna use the standard volume, which is pretty basic but very powerful. So we choose the volume indicator right here. The volume is represented by vertical bars, and the height of the bar represents the amount of volume. So when we have tall bars, like for example right here, that means that we have a lot of volume. And when we have small bars, like for example right here, that means that we have relatively low volume. To see the exact amount of volume, you can hover over a specific candle, which in this case is a specific day. You can for example see that during this day right here, Tesla had a volume of around 447 million, while the previous day had a volume at around 168 million, and the day before that had a volume of around 69 million. The color of the volume bar will be the same color as the candle. So if we have a green candle, meaning that the price have increased during the day, we will have a green volume bar. And if we have a red candle, meaning that the price have decreased during the day, we will have a red volume bar. When we have a green day, you can think about the volume as how many buyers are supporting the move. Or in other words, you can think about it as buying interest. However, when we have a red day, you can think about the volume as how many sellers are supporting the move, or another way to think about it is selling interest. So for example, when we have a green candle supported by lots of volume, this is very bullish, because not only is the price going up, but the price is going up while at the same time being supported by lots of buyers. Now guys, I want to show you all a quick but very important example of the importance of volume. So let's say that we have one daily candle right here, and we have another example of a daily candle. Oops, it's a bit ugly, but we have another example of a daily candle right here. Let's say that these two candles are the exact same size, but during the first candle, we have a volume of 1 million. And let's make this an extreme example and say that the other candle only had a volume of 10 shares. So the volume bar in this example would be super small, while the volume candle on the other example would be massive. So now, which of these two candles are more significant? Well, they have the exact same price gain, but in the example to the right here, it was only 10 shares that made the price go up, while in the other example, it was 1 million shares that had to be traded in order to push this price up.
Billions and billions.
So the example to the left here is much more significant and much more bullish, because so many more traders are supporting this move. So now guys, let's take a look at how to use volume to improve our trading and improve our win rate when it comes to trends, when it comes to reversals, and when it comes to trading breakouts. And guys, let's start here by taking a look at trends. So right now, as I'm speaking, I'm looking at a Forex chart. I'm on a daily time frame on the Euro USD. And as you can see right here, we have an impulsive move. And then we had a pullback, which is a move against the direction of the trend. And then we have a next impulsive move. And you can actually use volume to determine the strength of the trend. So is this right here a healthy trend, or is this a weak trend? And in an uptrend, what you want to look out for is that during the moves up, or during the impulsive moves, like we for example see right here, you want to see an increase in volume. And as you can see, when the price went up right here, we saw a strong increase in volume. When you have an uptrend and the price is pulling back, like for example right here, what you want to see is that you want to see the volume decrease. And as you can see in this case, when the price started to pull back, the volume bars got smaller and smaller, and the volume decreased. And then when the next impulsive move to the upside started here, you can see that the volume slowly started to increase once again. And this is exactly what you're looking out for in healthy uptrends. During the up moves, you want to see lots of volume, and during the pullbacks, you want to see decreasing volume. And the exact same principles can of course be used in downtrends as well. Now let's take a look at how to use volume to find better reversals. And what you always have to have in mind when finding reversals based on volume is the principle that the more volume we have, the more significant the move will be. So for example, right here we had a small uptrend. You can see we had impulse move, pullback, impulse move, pullback, impulse move. But what you can see is that during this red candle right here, we saw a very strong spike in volume. And this right here was a red candle. That means that many sellers supported the move. What you also can see with this particular candle right here was that it pretty much printed a bearish shooting star. And a bearish shooting star is a bearish Japanese candlestick pattern that indicates a potential reversal to the downside. And when you have a bearish candlestick pattern together with lots of volume, that basically means that many traders are agreeing that this is a valid bearish pattern, and it increases the likelihood of an eventual reversal to the downside. And you can see that in this case, this candle right here actually marked the end of the uptrend, but the uptrend did not transform right away to a downtrend. We actually transformed here into a trading range, but this was still the point that marked the end of the previous uptrend. And as you can see, eventually we actually saw a strong reversal of the price. Another way to use volume to identify reversals is to look for divergences. And what do I mean by this? Well, a divergence is when we have the price going in one direction while the volume is going in the other direction. So for example, as you can see right here, we're looking at the Apple daily chart. You can see that from this point to this point, the price printed a slightly higher high. But if you look down here to the volume, you can see that we have the volume going in the other direction and printing a lower high. It means that even though the price pushed higher, the move was supported by less buyers. And this right here is what we call a bearish volume divergence and indicates a potential reversal to the downside. And you can see that after this divergence, we started a corrective move here towards the downside. The third way to use volume to improve your trading is to use volume when it comes to breakouts. And this is super important. So when we see a breakout, like we for example saw right here, I'm still on the Apple chart here on a daily time frame. You can see that we saw resistance coming in, not only one time, two time, but three time. But during this green candle right here, you can see that we got a strong breakout above the resistance area. When we see breakouts, we want to look out for two things. First of all, we want to see a strong green candle, which we saw right here. This is a very good sign for a breakout. But what we also want to see in order to make the breakout even more significant is that we want to see lots of volume. And why is this the case? Well, when we see a breakout, we of course want to see lots of buyers supporting the move. And in this case, you can see that the volume bar was massive compared to all the previous candles. And this increases the likelihood of this being a real breakout and that we're gonna see a continuation towards the upside. If we now take a look at this example instead, we can see that once again we had a resistance level. We saw resistance coming in one time, two time, and then during this candle right here, we had an attempted breakout. But we had a few warning signs regarding this breakout. First of all, we can see that this candle was not really a momentum candle. It was not much larger than the previous candles. And the other warning sign we had on this potential breakout, let's go down here to the volume. You can see that the volume bar here was pretty much the exact same height as the previous volume bars. So we had many warning signs that this was not a strong breakout. And as you can see, just the candle after, we saw a red candle, and this was indeed a fake out, and the price started to push down.
So before we can start trading, actually buying and selling stuff, we need to sort of address the elephant in the room. How do we place orders? We need to know how to place buy and sell orders, and even more importantly, we need to know what types of orders that are available to us as traders. Without knowing order types, it's pretty much impossible to trade. So this is such an important part. And to understand order types, we first of all need to know the difference between what is called going long and going short. When you go long, for example, a stock, you look to make money from the price going up. And when you go short, you look to make money from the price going down. Being long is often called being bullish, and being short is often called being bearish. Alright, so now let's take a look at how long trades and short trades actually work. Long trades are in general very simple and much more simple than short trades. Let's say that this handsome guy right here is you, and you are looking to go long, so you want the price to increase. Let's say that you're looking to go long Apple and that the Apple stock is currently trading at $100. So you buy one Apple stock for $100 right here. If the price then increases to, let's say, $130, you will simply make the $30 minus a small commission fee. Let's just say $1. So you will make, let's say, 29 in total. One interesting and important thing about long selling is that your upside is unlimited. It's not impossible for Apple to go all the way up here to 1000, but at the same time, your max amount of loss is the 100 you paid for the stock. So going short, or in other words, short selling, is a little more complicated, but I will try my very best to make this explanation as quick and simple as possible. So first of all, remember that when we go short, we aim to make money when the market goes down. And how is this even possible? Well, the very first step in short selling is that we need to borrow a stock from someone else. And this guy, let's call him Rick, was kind enough to lend us one Apple stock. So after this, we owe Rick one Apple stock. And let's say that this right here is the price chart of Apple. And let's say that the current price once again is 100. And what we need to do here, just after borrowing the stock, is that we actually sell the stock right away. This right here is what we call short selling. So we sell the stock for 100 and now we have 100 in our bank account, but we also owe Rick one Apple stock. And now let's take a look at what happens if the price goes down to, let's say, $70. Well, what we now can do is that we can buy the stock, we can buy back the stock once again, but for $70. So after we buy back the stock, we give it back to Rick, thank you very much. And remember that we paid 70, so now we lost $70. But now look at what we have in our bank account. We got 100 when we sold the stock that we borrowed, and we lost $70 when we bought back the stock. So our total profit from this short selling is actually $30. However, we also had to pay some fees in the form of interest while Rick lended us the Apple stock. So the total profit here is equal to 30 minus the interest. And let's say that in this case, our total profit was 29. So now we know the difference between short trading and long trading. So now it's time to take a look at order types and exactly how they work. So first of all, order types are basically how you buy or sell an asset. And there are basically 5 different ways to do this. First of all, we have the buy limit order, and we also have the sell limit order. For the buy limit, let's say that this right here is the price. Let's say that the asset is currently trading at $100. And what the buy limit basically do is that it makes you place a limit order at a certain point in the market. So if the market is currently trading at 100, you can, for example, place a buy limit order at, let's say, 90. So if you place a buy limit order at 90, what this basically means is that if the price goes down here towards 90, it hits 90 or goes below, that means that your order will be filled and you now bought the asset or bought the stock. The buy limit order makes it so that if the price is at 90 or below, your order will get filled. So you may of course wonder, what happens if we place a buy limit order at, for example, 110 while the market is trading at 100? Well, what you basically tell your broker then is that you want to buy this asset if the price is at 110 or lower. So you will actually, if you place a buy limit order at 110, you will actually buy the stock right away at 100. So let me show you guys how this works in the real market. Right now, as we're speaking, I'm using TradingView, and I'm using the TradingView paper trading function, which allows you to trade for fake money here and practice on TradingView. By the way, guys, I will make sure to leave a link to TradingView down in the top of the description of this video. But now let's take a look at the limit order here. So what we do is that we go up here to our order tab for the paper trading, and we want to make sure that we are on the buy tab. Then we go down here to where it says limit for short limit order. And remember what the limit order does? It basically makes us place a buy order at a certain level. So let's say we place a buy order at 27,500. Right now, as we're speaking, you can see that we are trading at 27,530. But let's place this order right here. And you can see that our buy limit order appeared here on the chart. What this means is that when or if the price comes down to this level right here, 27,500, then we will buy the asset. But now I want to show you guys what happens if we set a buy limit order above the current price. So let's say that we place an order at 28,000 while the price is currently at 27,500. This will actually mean that we want to buy the price if it's at 28,000 or lower. So if we click buy right here, you can notice that we actually bought the asset right away, and we are currently in a position. The sell limit order is the exact same thing, but the opposite. Let's imagine we have a price here trading around $100, and what the sell limit order basically does is that it allows us to sell for a certain price. So if we place a sell limit here at 110, this basically means that when or if the price goes up here and reaches 110, we will sell the asset. So let's take a look at a real life example once again. We make sure that we are on the limit tab, but this time we go to sell. So let's, for example, say that we want to place a sell limit at 27,600. We type that in and we press sell. And as you can see, now our order type appeared here on the chart. This means that if or when the price goes up here to the sell limit, we will sell the asset. The next order types I want to talk about here is, first of all, the buy stop order and the sell stop order. These two order types should not be confused with a stop loss, because these two order types are basically the opposite of the buy limit and sell limit order. So let's start by taking a look at the buy stop order here to explain this. So let's once again say that we have the price trading here at, around, let's say once again, around $100. And when it comes to buy stop orders, what we basically do here is that we place an order that tells us to buy something only if the price goes up to that specific level. So we can, for example, place a buy stop order here at 110. And this will give an order to our broker that if the price goes up to 110, then we want to buy the asset. So this is pretty much the opposite of the buy limit. The same thing is true for the sell stop order here. Once again, let's imagine that the price is currently at 100. What the sell stop makes us do is that, let's say we place a sell stop down here at 90. This makes it so that only if the price goes down here to the 90 mark or below, that makes us sell the asset. All right, guys, so let's take a look at a real life example of the buy stop and sell stop order. So the first thing we want to do now is that we want to go here to where it says stop, the stop order type. So we press it right there, and let's start with the buy stop order. And remember, what the buy stop order makes us do is that we choose a level where when the price reaches this level, we buy the asset. So for example, right here, we can set our buy stop at 27,600. We go down here and we click buy to execute the trade. And then you can see that our buy stop order appeared here on the chart. This basically means that when and if the price goes up to this level, we will buy the asset. And the buy stop order, we can actually, let me show you, we go back here to the buy stop. And if you try to place a buy stop below where the price is currently, you can see right now we're trading at 27,540 around there.
So if we try to place a buy stop order below this point, you can see that it says that the order price is not appropriate for this order type or direction. So you can see that you can only set the buy stop order above where the price is right now. Let me show you guys this example for the sell order as well. Let's actually delete this order type where we are right now. Remember, the sell order, in this case, we can actually choose the price 27,000 because the sell order makes it so that if the price goes down to a certain point, we sell the asset. So let's execute the sell stop order right here. And as you can see, now a new order appeared here on the chart. This means that if Bitcoin falls all the way down here to 27,000, we will sell Bitcoin. The last order type I want to talk about is the market order. And the market order is very simple. This basically means that we buy or sell the asset at the current price. And let me show you guys how this works in a real life example. This time we go to where it says market here, which stands for market order. And let's say we want to buy for where we are right now. You can see right now we are at 27,500. We can simply press buy. And as you can see, we bought at that price and we are right now in a trade. Let's say that we now want to sell the position at market. Then we basically go here to where it says sell and we press sell. Now we sold the position, and in this case we actually got a small loss. So now guys, I want to talk about two things that you need to plan before every single trade. You need to have a stop loss and you need to have a profit target. And let's demonstrate this with an example. So in TradingView, we have two tools. You can see we have something called long position and something called short position. And let's say we have identified a long position right here. For now, you can ignore why I'm taking this trade. I will talk about that later because I do want to focus here on the stop loss and profit target. So a stop loss is basically a level you set here on the chart. So let's say I set this level right here. Once again, I will talk about why I'm setting this level later on. But a stop loss is a level that if the price goes down and goes below this level, then you will automatically get out and sell your position. And a profit target is the opposite. So if we set a profit target, for example, right here, that means that when or if the price comes up to this level right here, then we will automatically sell and take profit. And in TradingView, we actually have an amazing feature called paper trading, which is basically a tool you can use to practice with fake money. This is an absolutely amazing tool for beginners. And now to show you guys how to set your stop loss and how to set your profit target, I want to first show you guys how you can connect your TradingView account to paper trading. This is completely free. I'm currently logged in, so I want to log out for now. Let me see how I do this. Paper trader. Okay, so log out. So what you want to do here to start paper trading is that you want to go to the trading panel. You want to click on trading panel right here. You have to drag this one up a bit here and you simply press on paper trading. Then you press on connect and that's it. Now you can start practicing trading. So now before showing you guys exactly how to set your stop loss and profit target, let's just talk about why I took this trade right here. Well, first of all, we need to look a bit left. If we take a look at this price action right here, we can see that we saw an extremely strong move here towards the downside. However, during this red candle, you can see this massive red candle, we saw a very long lower wick. During this candle, we actually saw lots of buying pressure coming in. We can also see, if we look at the two candles right here, following the red candle, that the buying pressure continued. So this right here tells me something. It tells me that this is a potential level where we have lots of buying pressure. But since we only have one touch at this level, what we do want to see here is that we do want to see the price coming down to this level once again. And when the price reaches this level, we want to look at the price action. Hopefully by now you guys have watched the chapter on price action and also the chapter on market structure. So you know that it's very important how the price is reacting to a certain level. And here we can see that when the price came down to this level,
two very interesting things happen. First of all, you can see that we bounced here, you know, around the support area. What I actually do prefer when I draw support or resistance levels is to not use a line. I prefer to use like the rectangle tool here, because support and resistance are often more like zones rather than perfect lines. But yeah, we can first of all see that we saw some buyers stepping in here on the first red candle, but it is the next green candle that is very interesting. And to be more specific, the green candle together with the previous red candle prints something we call a bullish engulfing pattern, and that is a bullish Japanese candlestick pattern indicating a potential reversal to the upside. So we have a bullish candlestick pattern coming in at a level where we previously saw strong buying pressures. So by combining market structure and price action here, we can actually enter a long position. And let's take a look at where I entered here. I entered at the candle close of this candle. So I entered right here. This is basically when the bullish engulfing pattern got confirmed. But now let's talk about the stop loss level. So as you can see, in this case, I would not set my stop loss on this level. This is something that, you know, beginners do all the time. They set their stop loss level, you know, exactly at a support. And why is this a bad idea? Well, because many times, in this case, this was not true, but many times the price will come down to the support and perhaps, you know, wick below. Many times it will wick below the support before continuing to the upside. So when it comes to support levels, what I usually do, or pretty much all the time, is that I do want to leave lots of space here, or at least a little bit of space, you know, a little bit of wiggle room. Because in order for this support level to break, remember from the chapter about price action, we actually want to see a strong red candle close below this level. If we see a strong red candle close below the level, then we definitely don't want to be in this trade. And when it comes to profit targets, when it comes to trading, it's very seldom we have, you know, a one size fits all. A common risk to reward ratio is 2. This is a very, you know, simple and beginner friendly thing to just have your risk to reward of 2, meaning that, you know, the reward, so this part right here, is twice the length of the stop loss area. Another strategy is to use potential, you know, support or resistance levels or other market structure to set your profit target. And another thing you can do is that you can base your profit target on price action, but that is pretty advanced. So for this example, let's keep it simple. Let's do a 2-to-1 risk to reward ratio. And now I wanna show you guys how you can set your stop loss and profit target in practice. So when it comes to paper trading in TradingView, and if you connect any broker to TradingView, what you do here is that you right click on the chart, you go down to trade here, and you create a new order. Hopefully at this point you have already watched the chapter on order types. So let's keep this very simple and place a market order. So we buy 1 Bitcoin. This is quite a lot of money, but this is just an example. And now we want to check the take profit, and we want to check the stop loss. Let me move this one a bit to the left here so you can see. So what we now have to do is that we need to check the level where we have our profit target. As you can see, this one is at 42,542. So we write in 42,542 as our target level. And let's also check our stop loss. We can see that our stop loss, it is at 42,208. So 42,208. And it is this simple. The reason we can't press buy right now is because this is an historical example. You can see that the Bitcoin price right now is trading at another price. You can see that we are trading at 42,577 right now. So let's actually show you guys how we can do this in a live market. So let's just place a completely random trade, which is based on no analysis. I just want to show you guys how this works. So let's say that we, you know, set a stop loss, for example, right here, and set a 2-to-1 risk to reward ratio. So we click here, we go to trade, create new order. Once again, we repeat the process. We can see that the take profit is at 42,746. So take profit 42,747, around there, and our stop loss is at around 42,000. 495. And now you can see we can actually place the buy order. So let's place the buy order right here. And as you can see, just like that, we have our profit target, we have our stop loss, and here we have where we entered the trade. You can see because I was a bit slow, you can see that we actually entered a bit higher right here. So if you want to, you can of course adjust your trade. Now it looks more something like this. So in this case, because I was slow, our risk to reward ratio here is actually 1.78 instead. All right, so now guys, let's talk brokers, because in order to trade using real money, you need to use a broker. Brokers are basically the trading platforms where you actually buy and sell your crypto, stocks, or Forex. And here on the screen, you have a list with many different brokers that are actually supported by TradingView. So if you guys use any of these brokers, you can actually trade directly on TradingView. And when it comes to choosing a broker, I would love if I could just say, you know, this is the best broker or this is the best broker. But unfortunately, when it comes to brokers, there is no size that fits all. It will depend on many different factors. The first and one of the most important factors is what are you going to trade? Are you going to trade cryptocurrency? Are you going to trade stocks or Forex? I can give some just short recommendations here. If you plan to focus on crypto trading, then Binance is a very good choice. Binance is not only the largest crypto exchange, but it also has, you know, tons of different cryptocurrencies. It has many more different kinds of cryptocurrencies compared to, for example, Coinbase. And if you plan to trade stocks, you have, for example, Webull is a platform that focuses on stock trading, and you can also trade, for example, ETFs. But if you're going to focus on trading Forex, we of course have, for example, Forex.com, that is a popular broker, Oanda, yet another one. So the first question you have to ask yourself is, what do you want to trade? But as a beginner, I know that I have been mentioning this a lot, but I highly recommend that you start here by paper trading. By using paper trading and practicing with fake money, you can try out the different markets. You can, for example, try trading crypto, try trading stocks and Forex, and see what sort of works best for you. But the second sort of issue when it comes to choosing a broker is that, you know, not all brokers are available everywhere. For example, when I trade, I use TradingView for my analysis, and I use a Swedish broker called Avanza to actually execute my trades. Or at least some trades, because for some cryptocurrency I will need to use a crypto exchange, but it's definitely a possibility to use TradingView as your analysis platform and then use a separate platform for your trades. You don't have to use any of these brokers right here. Another thing you have to consider is that, you know, every country will have different laws and regulations. For example, in the US, you have something called the PDT rule that I definitely recommend that you read up on if you live in the US and plan to trade on margin. Yet another important thing to consider is, of course, commissions and fees. When you buy and sell, there will often be transaction fees involved. So choosing a broker that has low fees is, of course, in general a good thing to do. However, some traders might prioritize, you know, paying a bit higher fees if they get, you know, a much better service, and so on and so on. So yeah guys, I wish I could give you like a more straight answer on this issue, but the only true answer here is that it depends. Alright guys, so this course is actually coming to an end. If you guys made it through this whole course, congratulations. If you want to, you can comment something like made it till the end. I hope that you both had fun, but even more importantly, that you got a lot of value from this course. However guys, I have a whole list of other topics, super important topics that we need to talk about in the future. I'm talking about things such as risk management, we haven't really touched upon that, you know, trading psychology, we haven't even talked about trading indicators, and pretty much on all subjects we have been talking about today, we can of course dive even deeper. But if you have made it through this whole course, I don't think you have only taken, you know, one step towards becoming profitable, you have taken many steps. But yeah, if you guys did enjoy this long video, it's super awesome and helpful if you show that by dropping a like. I'm super thankful for every like, and of course, if you have any questions, make sure to drop a comment down below. And also, if you have any suggestions about topics you want me to dive deeper on, let me know in the comments about that as well. And also guys, if you want a part 2, also let me know. I'm definitely planning on making a part 2 on this video if you guys actually liked it. But yeah, until next time, make sure to practice and practice and practice and use paper trading. Practice using paper trading. But for now, take care. Ciao, ciao. So when part 2 of this course is out, I will make sure to display the video right here. But meanwhile, if you want to dive deeper into candlesticks and candlestick patterns, I actually have a 1.5 course about that subject alone.